Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about how the wild tariff news from this week will affect housing, specifically mortgage rates. Logan, welcome back to the podcast. Wow.
Just wow. And you called me last night and you're like, why do you sound so calm? Why, and I
This after
said,
the tariff news, after we got the
yeah.
tariff news.
And we have a lot to talk about, but first let's go back to the tracker article where we said, can mortgage rates go lower? And we said that key technical level with the bond market has been very sturdy. It's held up with a lot of negative news. And originally, when the first tariff news, like 10% across, came, bond yields went up, stock futures went up. We would not be having this conversation today if that was the case, if there was just 10% tariffs on everyone. But the reciprocal tariffs and how they calculated that, for all my nerdy friends who know what I'm talking about, that was absolutely gold. But in any case, that was so extreme that initially the bond market just tanked and it fell throughout the day. And then now the stock market, where it's Thursday morning right now. And this is all happening with the labor data this week has been fine. I mean, job openings, nothing spectacular there. ADP data beat estimates. Jobless claims fell. There's nothing on that side, but because the tariff news and some ISM orders came in weak and everything looking out forward, bond yields just cracked through that. Stocks are selling off in that. So we were able to break it through forward-looking kind of guidance on what could possibly happen with the economy, brought mortgage rates to the lowest levels of the year. And we always focus on housing here. So before all that happened, purchase application data again, positive. And our spring data line for the first time now going into April has had positive year-to-date data, has had positive year-over-year data, and it's kind of picking up. And now today is the first day that we've gone below 6.64%. If you're using Matt's Mortgage Daily, it's at 6.63. The spreads were bad today, but the move was such a violent move that rates went lower. And if mortgage rates just head towards 6%, what have we said, Sarah? From the start of the year, everyone's forecast is wrong. Nobody's really talking about the purchase application data. I think there's a lot of people who are they'd rather talk about one house in Florida that was bought in 2022 that is down 30% instead of focusing on the economics.
So let's talk about those tariffs. So were you surprised? I think everyone was kind of like, what's the strategy behind this? And how does this fit into your whole, it depends on the trade war tap dance, and is he really going to do it? And like, give us your take on that.
So when we did that November 7th podcast, we said, okay, listen, this is not going to work with higher mortgage rates, and you're not going to go into this trade war right away. So you're going to see a lot of tariff ons, tariff off. But the last 6 weeks, we've said, this is kind of not working. You can't sit here and just do this back and forth thing. You're going to have to pull the trigger. This is my observation take. When I first looked at that chart, I mean, I laughed. I said, this is funny. And my second take was, imagine what we talked about in the last podcast. Imagine you need to make a decision and you kind of don't know what to do. Do you try to just go back and forth with countries? No, I mean, that's obviously that's not working for the White House. But what if you went full blitz mode, right? And a lot of people might disagree with my take here. What if you went with a full, listen, you guys can't handle this stuff. Our labor market isn't broken yet, but I can go full blitz and force you to make deals. Now, there are people out there in the White House that said there's no deals going to be done. And then 20 minutes later, somebody from the White House said, yes, there's going to be deals done. If you look at it in this light, and this is how I explained it on Twitter today, because there are actually people who said, why isn't the bond yields much lower today? Why aren't stocks selling off even more? The jobless claims data hasn't broken yet, right? If jobless claims were running at 300,000, we wouldn't be doing this. You have a little bit of time before, these tariffs, the longer this stuff goes in, the more problematic it gets for the economy. But imagine for the next 9 to 12 weeks, or even shorter than that, you start to get something that's workable. Because if you really believed in this as the policy, you would have done this on day one. Or if you really believe, like to me, if you really believe that you want to change the entire structure of the US economy, you have to kind of like slowly move this in and get people prepared. Why? 2-year political cycles. So what happened is the Senate Republicans kind of fought back on Trump on the tariffs on Canada, but the House didn't. Imagine an economy dealing with this for 2 years, then the 2-year political cycle, Congress comes up. It's very difficult to kind of think long-term in a democracy. If you're a dictator and you don't have to worry about re-elections or Congress or anything, you can do whatever you want. And this is why dictator economies aren't that good. But here, imagine you just have a little bit of window before the labor data starts to get hit, and then you go for it, right? You force people to make deals, because the strategy back and forth, I don't know, is it fentanyl? Is it trade deficit? Is it manufacturing jobs? Do you want the dollar weaker to sell? But one of the quiet things that I saw in the last 48 hours is that Europe was planning on not buying like US weapons or something from us. And a trade war, the problem with the trade war is countries do this, countries do that, countries are, we're not going to buy this, we're not going to travel here. It's not the most efficient way, and you need time and kind of a slow process. So the fact that it was so aggressive, it just took out that card to me, and that we are trying to not bluff your way out of it, but force your way into getting some deals. Now, if I'm wrong about this, then this stays forever, no matter what happens to the economy. I'm going to take the other side on that bet, because 2-year political cycles, it's difficult to do something like this when you do it fast. If you try to do something timed and measured, the White House's own tariff guy said, you have to like slowly get tariffs into the process so they don't become damaging to the economy. We're already talking about farmer bailouts now. If we're going to be rich or something, there's these things that the way it was done and the calculations, it just seems like to me, hey, let's just go for it and then see. And if I'm wrong, then this never changes. And in a sense, it'll be better for housing, because, you're going to get some economic weakness happening over the next 12 months. That should push lower rates. The counter to that is, well, they're already estimating 3, 4, 5% inflation rates because of the scale. We're not talking about 2018 anymore in small prog. We're talking scale everywhere. So it becomes a tug of war on this. But it just, Sarah, it gets more interesting. And we talked about this in the last podcast. He's got to do something. So what is he? Does he do something that he doesn't really want to go into, or does he have something kind of in the middle? And I thought the 10% tariff thing was going to be one of those things that it's not that detrimental to the economy, and bond yields and rates, bond yields would have gone up, stocks would have gone up. But here, this is like guns of Navarone. This is like a thing that you got a lot of people more concerned going out in the future.
Okay, so you wrote an article today on this very subject, that like the tariffs had dropped 10-year yield and mortgage rates. So for housing, when we look at this in terms of housing, there's a couple of things. So you have mortgage rates on this side. Then if you have, just instability, volatility in people's stocks, whatever, it can make them feel like I should just hold, correct?
I do not believe in that concept for this reason.
Okay.
Over the last 14 years, whenever rates fell, demand picked up. Whether it was COVID, whether it was here. I mean, think about this in this rationality. We've had a lot of crazy headlines, November, December, January, February. March. Majority of this time, purchase application data is positive with elevated rates. Sarah Wheeler, elevated rates. We're not talking 3% mortgage rates or 4% mortgage rates, because that low, people are going, hey, I got to go in. But with elevated rates, purchase application data is positive. It was actually had a positive curve in November and December. Okay, that's seasonality. I'm willing to take that. But this January, February, March, for it to be positive with elevated rates, no. Obviously, people are like, we're going with it. Because why? Housing's one of these things that every single year people need, right? It's the affordability. But if there was a period of time in history, COVID, crazy, right? Are we going to die? Behavior. Everyone stopped doing it. Oh my God, let's go back. 3% mortgage rates. Here, November, December, January, February, March, crazy headlines. So far, purchase application data is positive. Now, the counter to me is, well, the negative impacts have not happened yet, and everybody's talking about a recession. And I said, okay, well, then we have to go there. But just, a stock trader came to me, and a lot of people are saying this, well, nobody will have jobs and money. It's 162 million people working.
Right.
What happened with COVID? Everybody fought me on COVID because they said, Logan, 30 million people are unemployed. I said, you forgot 5 million in forbearance, 35 million off the grid. They're like, how do you think my army is bigger than yours? I got 133 million people here. They're armed to the teeth. They'll take your 35 million every time and win. Now, back then, affordability was better, mortgage rates were better. But in this case, what we're talking about is, how do we adjust to the realities of a trade war tap dance that could hit the economy, but it pushes rates down lower? The question is, do rates go even lower if the inflation data picks up? Now this is different, because the standard answer would be, well, there's no way a negative economic curve will disinflationary. Inflation won't be able to stick up because the economy people will pull back on spending with everything that's the counter to the inflation argument. Then the other argument is, well, guess what? Household formation, household balance sheets, all these things are good. People still need to consume in goods. They'll take the higher cost. That's the tug of war that we don't know yet. I see both sides. Both sides are valid out here. Now, the original process was, well, inflation is going to take off, rates are going to take off, and I thought, well, you're really bullish on the economy then, because that, typically doesn't happen, unless people could consume goods and services out there. So, and we saw that during COVID, right? During COVID, even with the growth rate of inflation, consumption data was fine. But now, with elevated rates, it could be a little bit more problematic on that side. So both teams have valid points now, and we're going to have to see what happens over the next 12 months on this, because this is just day one of this. And I still think this looks like a full-blown blitz to get some deals. They could have gone full 100% tariffs, reciprocal on people. They went half. And they even talked about maybe there was ways that people can lower their things. So I think one of the things is you have so many different people from the White House saying different things that it confuses people. So again, everyone get on the same page, and then we'll take it one day at a time. But for everyone that's listening, that's mortgage and real estate, purchase application data was positive before rates broke here. And traditionally over the last 2 years, they tend to get better when rates go from 6.63 down to 6. But it's also now we're in spring, and it's so much different this year than last year. Last year, 6.63 to 7.5, 14 negative prints, only 2 positive, only 2 flats, 0 year-over-year growth. This year, 6 positive, 3 negative, 3 flats. Majority of the year's year-over-year growth. And now rates are going lower to a level. So much different backdrop. It's very exciting and very invigorating. And we'll take it.
Okay. So, one of the things that I always see on social is people are like, they listen to you so that they can then, translate for their consumers, for their clients, and be like, here's how you should be interpreting this. And here's why it might still be a good time to buy a home if you need a home. So if you're in that position right now, you're back as an LO, which you were for many years. What are you telling people?
Sarah, ask me.
No, I'm not going
Ask
to
me,
ask
Sarah.
you.
Sarah, ask me
No,
if you should buy a
that's
house.
not the question. That's not the question I want you to
I
answer.
know, but
It's
you
not.
asked me my LO self. Our family's been in banking since the late 1950s. We've seen a lot of economic cycles. But one thing is constant. Millions and millions of people buy homes every single year. They're ready, right? Because the process takes usually a year to go into it. You're actually thinking, okay, we're going into that. Are there marginal home buyers that need to be convinced? Your job is not to convince people. Your job is to basically get your client, if you're a realtor, get them to a loan officer, have them pre-qualified as soon as possible. This is their payment. Okay, there it is. And then you show them where it is. Prices are going up, prices are going down, payments, HOA, insurance. Get them focus on that total payment. And then you're not wasting your time on somebody who's like, I don't know if I should buy a house. Okay, there's a lot of those, but they're not serious people. The serious people are the people already filling out the purchase application data this year, even with elevated rates, because you got to buy. I mean, this thing doesn't go to zero. Home sales don't go to zero. We're going to be near 5 million home sales again this year, total home sales, just like the last 2 years. Focus your energy on serious people. But if you're asking me, and I've always said this, if somebody asks me, should I buy a house? I will tell them no, because you're not ready. Because
I
millions
know.
of people are buying homes every year. They're ready. You go get yourself a loan officer, find the total payment. If that payment works for you, be part of society. But if you're asking me, no, I don't think emotionally you're ready. I don't think you're financially ready because you're asking me. You should not be asking me this.
I know.
Right?
This
It's
is
like
your
those
trigger
people like,
point.
oh, listen to those people on YouTube. And then, do you guys realize the people on YouTube have said prices are going to fall for 5 years in a row? And now they're going, FHA, FHA. Oh, I still can't. I'm still not over that multifamily. Oh my God, Sarah, I have a whole list of people that I want to debate, in which we're going to have one of those debates next year or next week. But there is a whole list of people that need to be just like regulated and checked. But if you're talking about clients, man, listen, get them to a loan, get the payment and go, right? Because you need to spend your energy on people that are serious. So far, even with the crazy headlines, purchase application data is positive. I'm just going to go with the aggregate data out here. But again, what's housing? It's a fixed debt cost. Wages rise, property taxes rise, insurance rise, right? But get yourself as informed with the total payment level. And again, everybody's situation is different, right? Some people have jobs that they're not sure about. Some people are very secure. I mean, but get them into the program as soon as possible in terms of what their payment is, and go. If they're not ready, they're not ready. But don't get into the I need to convince you stage. That's not anyone's job. That's the person who's buying the house. They should not have a problem with that total payment, because you're staying there for a long time.
Right.
And that's the way it goes. I'm not a big believer of, that's why I have that answer every time when people ask me, should I buy a house?
I
And I
know
go,
you do.
no, you're so not ready. I wouldn't even have you go get me a glass of milk from the refrigerator, let alone buy a house.
Okay. Okay. Let's talk about, you mentioned recession earlier. I know we don't know what's happening with jobs. That we're recording this on Thursday. We won't know what the jobs report is. But when you look at what your recession model, what does that look like right now? Are you on recession watch? What are you looking at?
There is the labor triggers have not happened yet. So until the labor triggers happen, I don't want to even go there, because I don't want to be like every terrible person on Twitter and YouTube that keeps on saying recession, and then 14 years, because I physically just, I would like, again, I would swallow my own vomit if I was that bad. If I woke up every single day being that bad, and then thinking to myself, I look in the mirror and go, oh my God, you're so amazing. These people don't realize the Fed's balance sheets, everything is fake, manipulation. I live once. I want to be happy, smile. I want to show off this hair. I want to go out and teach economics. I don't want to be them,
Right.
because that's the devil's work, right? Every day, recession. No. When the labor triggers start to go off, we can go there. So far, residential hasn't. It's not looking great. Manufacturing, that's not looking at. These are labor triggers that happen with every economic cycle. So we're mindful of this. And like this week, I would tell you this, if we didn't have any tariff discussion this week, everybody like, oh, the labor data is okay. Bond yields would be like probably at 4.35 right now, the 10-year yield. But we took a different route on the tariff thing. So we'll see what happens. But again, the game's changed now. Going out in the future is the thing. Like what's going to happen? Like the past is the past. Now we have to look because we now incorporated another variable. Whether they stick with it or not, time will tell. But we incorporated another variable that was not in the equation at the start of the year. It's kind of like in 2023 when the spreads got worse. We would not have had 8% mortgage rates if the spreads didn't get bad after the Silicon Valley. That was a Silicon Valley banking crisis event, and the spreads got bad. That was a new variable. So it added, 0.5% to the mortgage rate on that year. Here, now we could go on and see how it is. Now, of course, maybe 2 weeks from now, things are changing. But until then, for housing, 10-year yield fell because, again, if the economic data is getting weaker, traditionally bond yields fall. And by the way, for all the people that are still saying mortgage rates can't fall because the mortgage-backed securities, they're flowing. Guys, rates fell from 8 to 6%, right? Mortgage rates can't fall because America's broke. Nobody's going to buy our 10-year. Guys, hey, 8 to 6%. Come on, let that go, right? That's not a thing. We are the most wealthiest. Forget about the $190 trillion of financial assets. You can put the U.S. in together, the land and everything. It's like $400 trillion. My God, stop thinking we're a third world country. What was it? The island of McDonald's, or what was that? Where the penguins are? We have a 10% tariff on penguins because they're ripping us off.
Those penguins, man, who even knew they were our enemies? Lord. We didn't even know it.
So
they're crafty.
So yeah, again, economic data for now. If it gets weaker, bond yields fall. We know this. Now, if the growth rate of inflation is higher and the Fed gets a little bit more aggressive, that's where the trick is. Unfortunately, Sarah, I think this is going to be the case. What? I think in the minds of all of us that watch the market, we don't actually believe that a sitting president would go after the Federal Reserve and start firing board members. But with everything that's been going on, I think Powell and them are in risk because knowing Powell and them, they're going to take it slow and they're not going to be proactive. And we can see what's happening is that the whole thing was real. I mean, the game plan actually worked. They talked about we're lower rates and we brought this up and here it is. But the counter to this is if Powell takes a more hawkish tuck, I would not be surprised if they find there's like verbiage in old paperwork that's maybe people can interpret it that you can fire the Federal Reserve and board members and get people in that are on your team. That's something I hope that does not happen. But if this prolongs, right, right now, one of the things is they wanted lower mortgage rates to get housing up. Lower mortgage rates has already boosted housing just a little bit. That could be something going out in the future. I don't know how the markets would react to that, but that is definitely in play considering everything else.
Well, that's notable that you say that because I've been bringing these things up for months, and you're like, no, because you take a very moderate stance, and you're like, I don't think that's what's going to happen. So I think it's notable that you're like, if they need to cover the tariffs with lower rates, then maybe they feel like they have to do that.
Well, when I went on CNBC and the headline was the cure for tariffs is lower rates, you could see what's happening. There's one sector of the economy that's kind of looking better, right? Oddly enough, who had that bingo card by the end of March? It was the existing home sales market that's actually the outperformer, just on the forward-looking demand curve. But here, the longer this tariff thing goes, the more I could see him try. I don't believe he can do this. I mean, I've read some of the stuff, but I could totally see him doing it now. And remember, Michelle Bowman, who is just promoted, she even said, well, I know I've been really stressed on inflation, but if the labor market gets weaker, we're going to focus on that. And I was like, oh, Nelly, the lady who's going to get a promotion is now labor over inflation. So I don't know. There's a lot of pieces now that we just have to put in the mix.
Logan, thank you so much. Super interesting episode. Good news on mortgage rates going lower. We'll see what happens tomorrow by the time this comes out. And of course, you'll be writing about it as it happens, so people can check back there. You have your hand on the pulse.
And remember that Jobs Friday is today. This podcast will come maybe right when the report comes out. And always remember, residential construction workers, the whole model early on in the year was about if everything stays constant, the unemployment rate should rise. The Fed kept their unemployment rate targets low for something of a surprise. They already have raised that unemployment target once. The question now going out is, do they do this again? Because if they do this again and they have their dual mandate, do they say we need to be a little bit more dovish because these are aggressive tariffs? So that's the question mark now. Like, what do they do? Right. And I'm pretty sure Trump would be like, cut rates, end the balance sheets, do QE, everything to kind of push rates, because you could mitigate the damage to a degree until you figure what you want to do really with tariffs. You want to get deals or not deals.
What do you keep saying? It's going to be an interesting 4 years. It continues.
It's going to be every week, man. It's just since 2020, everything is just like, but it's fun. I'm telling you, I love it.
It is not fun.
I love this. I know that everyone's like, oh, everyone's stressed. But if you're looking at me, I'm ready to ball now 24/7. And every day I get up and go, oh yeah, let's go.
I'm glad someone's having fun in the middle of this craziness. All right, Logan, thank you so much. Appreciate you.
Pleasure.